time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold.
OpenText symbol OTEX on the TSX currently trades at $51, up roughly 25% year to date. And with a market cap of just under $14 billion, it pays a dividend yield of about 2.5%. OpenText describes itself as a leader in a $92 billion and growing information management market, delivering a compelling cloud-based platform of software and solutions that uniquely positions OpenText to win customers and continue to take market share regardless of the economic environment. OpenText has 5 cloud segments: Content Cloud, Business Network Cloud, Experience Cloud, Security and Protection Cloud, and Developer Cloud. First, looking at the income statement for OpenText's most recent quarter, fiscal Q2 2023, which ended calendar Q4 at the end of the year 2022. So they're delayed, or they're forward about 6 months. The company reports in US dollars, so all the numbers that I'll be saying are US dollars besides the market cap, which I previously said. Total revenue was up about 2.4% to $897 million, and on a constant currency basis, about 7.8%. Annual recurring revenue, or ARR, was up 3.6% to $725 million, and 8.7% on a constant currency basis. Adjusted EBITDA, on the other hand, was down 0.8% to $340.9 million. GAAP net income was up 192.7% to $258 million, but this was just largely due to some accounting numbers of unrealized derivative gains relating to their acquisition, which followed the quarter of Micro Focus. Removing this single unrealized gain, which is effectively just the accounting number, net income really fell 2% to $86.5 million. So before I get into the balance sheet, we're going to take a quick detour into management expectations, as the performance is going to be significantly altered as they finish their acquisition of Micro Focus on January 31st of 2023. So for fiscal 2023, the company now expects 28 to 30% revenue growth, with only 1 to 2% being from organic. So non-organic is from acquisitions or things like that. So if you acquire a product, if you acquire a company like they did in this case, that's inorganic growth. Organic growth from the products you already own and operate. So the difference is just really due to the company's core operations being as a software acquirer. So that's why you're getting that big total growth, but low organic growth. And much of the companies which they've historically acquired, as well as Micro Focus, are already in the mature stage of growth. So they don't have much organic growth of their own when they're acquiring. So past their initial acquisition, you don't really see much growth past that. And they have their aspirational targets in fiscal 2026, which they already moved back from fiscal 2025 of organic growth to 2 to 4%. So it's not really increasing much. The company does, however, forecast that it's going to be able to increase its adjusted EBITDA margin, forecasting 32.5% to 33.5% for fiscal 23, and then up to 38 to 40% of their aspirational margin for 2026. So clearly the management really doesn't expect much organic growth going forward. It's not really a shift. It actually is a bit lower with their integration of Micro Focus, as it has historically lower organic growth, but they really expect to be able to deliver value through margin expansion. So at the end of Q2 23, OpenText had a cash and cash equivalents of $2.82 billion and total debt and leases of $5.45 billion, resulting in a net debt position of $2.63 billion. Using the trailing 12 months adjusted EBITDA, we get a net debt adjusted EBITDA ratio of about 2.1 times. This ratio is already quite high, but it's kind of expected given the historic acquisitions they've done. I think about a dozen of these over the past decade. So it's not really that surprising. However, debt is going higher following their acquisition of Micro Focus. So debt is now expected to be about $9.3 billion, excluding cash, with a weighted average of interest rate of 6.3%, which is quite high. Just last year, they were closer to about 4% for their interest rate, and moving up to 6.3% is obviously quite a bit bigger. And along with this acquisition, quite a bit of their debt, which was about 80% of it was about fixed before this, now it's about half fixed, half variable. So they're much more sensitive to interest rates, and given the interest rate environment, it can be quite risky, to say the least, to hold variable rate interest. So given the acquisition price was $5.8 billion, we can add that to net debt, giving a rough pro forma net debt position of $8.4 billion at the end of this quarter. So effectively today, when we're recording this will be the end of their next quarter. This is a rough number, just so if someone is looking at this a couple months down the line and the earnings have actually been released and the numbers different, that's why. The company does expect to pay down debt starting at the end of Q4 2023, so about midway calendar year for this year, of about 175 million per quarter. So they are planning to pay off debt, but the debt is quite big to say the least right now. So moving on to valuations using the pro forma estimated numbers and forward fiscal 2024. So this is about midway through 2024. We get an EV to adjusted EBITDA of 8.5 times. It is better than their trailing EV adjusted EBITDA of 12.4 times, but it makes sense as it's going forward. So you'd always expect a lower number going forward, assuming they're growing, as well as the addition of Micro Focus. They paid 6.7 times. So that's lower. So that would further lower the forward multiple, as well as just the synergies which they do expect to get out of the integration will further lower the multiples. That being said, that is still quite an expensive multiple given the organic growth, even once the integration is completed. Overall, the company is just significantly leveraged going forward and having significant interest rate risk, and it still trades at quite a pricey multiple given its organic growth.
No, I was comprehensive and really, I mean, two things here. So the main reason that performance just over time has not been, over the last, say, several years anyways, has not been great for OpenText, at least relative to other tech stocks. Last year notwithstanding, because obviously that was a poor year for the tech sector, extremely poor. But it really comes down to the organic growth. So OpenText has never really been able to produce a decent level of organic growth. It's generally been in that 1 to 2% range. Whereas other companies in the cloud space or in the software space, generally speaking, they're more organic growth engines, right? So very little, like if you take Fortinet, just for example, different industry, of course, but Fortinet in the cybersecurity space, growing their revenues in the range of like 20, 30% or above. Very little of that is acquisition. The vast majority of that is organic. And that is a combination of one, growth in the market, and then also increasing market share. You could also look at Microsoft as well. Look at their Azure cloud platform, which is, still different in the cloud space, but it's more similarly aligned because they're both cloud businesses. Growing their revenue, their cloud revenue by, say 25, 30%. None of that really, or very little of that, is acquisition. That's organic, right? So when you look at OpenText, I mean, being that they are a cloud company, a software company, they have been in growing markets, yet their growth in the business has come almost solely from acquisition. And as you said, Brett, acquisition growth in most cases is just kind of one and done, right? Like you acquire a bunch of revenue, you acquire a bunch of earnings, and then, unless those new assets have organic growth, you have to go right out again next year and make another big acquisition in order to maintain order to maintain revenue and earnings growth. So that's been one of the biggest issues. That debt, I mean, that increase in debt from about 2.5 to 8.5 billion, that would concern me. A lot of these companies in the software space have very little debt or have no debt. They're actually net cash businesses. Microsoft, I think, is close to about net neutral, but most of them are that we look at anyways are actually cash rich. So that's a concern. And then another thing is that I guess kind of the argument in favor of OpenText in many ways over, say, most of the past 3-4 years has been, well, yeah, it doesn't have the growth of some of those other software businesses, but most of those software businesses are trading at astronomically high valuations, whereas with OpenText, you're getting it at a big discount. But then with the collapse of tech sector valuations, sure, it's still at a discount. I mean, if you look at analyst earnings expectations, it's trading well below 10 times non-GAAP EPS, right? Which is still a big discount, but the discount is narrowed. It's not as big as it was before, right? So you ask yourself, do you want to buy a Microsoft at 28 times or OpenText at 8? For me, I would go with a Microsoft.
Sorry. Go.
I think that really comes down to their really acquisition strategy. They're getting those mature softwares. They're not getting the next big thing like Microsoft is really looking to with their AI, their chat GPT in those sectors. Obviously, it's not cloud computing directly, but that's really where I see it. They're acquiring mature software, so you're not going to get that organic growth like we're seeing elsewhere. So it's just that fundamental operational flaw in expectations. And then they're adding leverage on top of that to really, they're trying to drive shareholder return through leverage, but obviously that will bite you in the butt eventually. And I think that is what we could see potentially with this increased leverage that we're seeing after the Micro Focus acquisition.
Mm-hmm. And then that 1.5, if they're able to hit that 1.5 billion in free cash flow, that looks really good. But how many new shares do they have to issue to get there? And then, you're looking at a low valuation company, but a company that has high debt. So you have to balance those things, right?
Yep, without a doubt. It's a good summary. Thank you.